Hey everybody, welcome to Chapter 11. Chapter 11 has to do with equity financing, or not just equity financing, but equity in general. If you remember, the balance sheet has assets, liabilities, and equity. We always say that equity is the part of the company that's owned by the owners as opposed to owned by the bank. That's why the assets are the same as all of the debt, the amount that's owned by the bank, and the equity, the amount that's owned by the owners. Anyway, so we'll talk about that in this chapter. If I can get my clicker to click. I'm having clicker problems, but we'll figure that out here shortly. Oh, I see why, because my clicker is not plugged in. Should work now. Anyway, so here's the learning objectives. You had lots of time to look at them while I was messing around with my clicker. So check those out. There's the preview. So here's the idea. So typically speaking, a business entity or an entity is broken into one of a few times. First, we classify them by purpose. They're either not-for-profit or they're for-profit. And then the for-profit businesses are either publicly held, meaning they're owned by shareholders who can publicly buy shares, or they're privately held, meaning the shareholders cannot just sell the shares to anybody in the public. Most of the company names you've heard of are publicly held for-profit businesses. A handful are privately held. My little tiny business that I own, that is a for-profit business that's privately held by individuals, and we don't sell the shares at the market. So a corporation is a certain type of business that has a few characteristics. The biggie is that it has separate legal existence, meaning it is its own entity. It's like a person almost from a legal standpoint. It's separate from the owners as opposed to being the same entity as the owners of the business. The stockholders are limited in liability, meaning if the business gets sued, the stockholders aren't really getting sued. Their liability is limited only to the amount that they own the business, not all of their assets. Rights of ownership are transferable. The business or the corporation can acquire capital. It has continuous life, meaning if owners die, the business keeps on going. It doesn't die with the owners. It's got corporate management, which we'll talk about in a minute. And then there's some disadvantages there. Corporate management you'll see is both an advantage and a disadvantage. The disadvantage of the biggie is the additional taxes. Corporate earnings are kind of double taxed because the corporation, because it's a separate entity, gets taxed, has to file its own tax return, and then its dividends, which are shares of the profits that are passed through the owners, they get taxed again. So that is the downside. Oh, I was supposed to, as I talked about them, go through this. I'm a terrible clicker manager. You see, each of those kind of tells about the things I was just telling about. There you go. I should have done that as I was chatting, but you know, I didn't. All right. So there's a corporate form of organization. You see the stockholders at the top. The stockholders equal the owners. Okay. Sometimes they use the word stockholders like it sounds like it's different than the owners, but the stockholders own the business. The stockholders elect a board of directors, and then the board of directors hire president and chief executive officer, and they hire all the people below them. So that's how a corporation is formed. That's a good thing because it's very organized and it takes all of the management decisions out of the owner's hands. That's a hard thing when you have to make all those decisions. But it's also a disadvantage because if you're the owner, you sometimes want to have more management power, and you don't because it's split up in such a way. Also, it's expensive, right? You have to pay salaries to all these people. So pluses and minuses in that corporate form of organization. Other types of businesses that we won't spend much time on, although if you're serious about ever starting your own business, you should check these out. Limited partnerships, LLPs, LLCs, and S corporations. So I won't, like I said, I won't spend any real time on that other than to say, if you're going to start your own business, it's worth checking into these. My business is a limited liability company, LLC. And the cool thing about LLCs is you can choose which type of structure you want to be taxed as. An S corporation is cool because it doesn't have that double taxation. And for small businesses, that's a better usually structure than the normal corporation, which is also called a C corporation. All right, so if you want to form a corporation, here's what you have to do. You have to file an application with the Secretary of State. That's the Secretary of State for the state you're in, not the federal Secretary of State. The state grants a charter. So all corporations are creations of the state, not of the federal government. And then the corporation develops bylaws, which they usually have to file with the Secretary of State, or in Arizona we have something called the Arizona Corporation Commission, which is its own entity, even though it's kind of part of Secretary of State's purview, but it has independently elected commissioners. So each state's a little different. So that's how you do it. All right, so if you're a stockholder, if you go out and buy some stock, what rights do you have? The first is that you get to vote. You get to choose your board of directors and any actions that will require stockholder approval. Those actions would be listed in the charter. You also have a right to a share of corporate earnings through receipt of dividends. That being said, sometimes corporations make a choice not to pay dividends because they want to put the profits back into growing the business. So, but any earnings that are paid out in dividends, you have a share of those. You also have a right to keep your percentage of ownership even if the company issues more shares. So if you own 10% of the company, the board of directors can't issue more shares and then you end up not owning 10% anymore. So you always keep the same percentage of ownership, meaning when new shares are issued, you get a portion of those shares so that you maintain your percentage of ownership. And if the company ever gets liquidated, meaning goes out of business, and they sell the assets of the company after you pay off all the debts, then whatever's left over belongs to you, or at least a percentage equal to your share of ownership. That's called a residual claim. All right, so now there's a bunch of terms in this chapter, terms you're probably not used to. The first is authorized stock. So in the charter, that form or document that you file with the Secretary of State when you create a corporation, you will state how many shares of stock the company will be authorized to sell. The reason companies do this, if you think about it, is they're selling off a portion of themselves to raise capital, to raise money for using on other things. If I needed money to build a new state-of-the-art building at my facility, I might sell 30% of my company to other owners. I would still retain 70%, but I would use that money that I raised by selling the 30% to build that building. This is why companies issue stock, so that they can raise capital. This is a stock certificate for the Franklin Life Company. You'll see a couple things on there up in the upper right-hand corner. There's the number of shares, and then there's other general information. The most important thing here is the number of shares. This doesn't have a maturity date or anything like that. This just says that you own 100 shares of the company. These certificates don't really get used anymore. Almost all stock transactions are electronic, and you have a brokerage account where you hold shares electronically. All right. So corporations can either issue common stock directly or indirectly through an investment banking firm. Most big companies that you've heard of are done through an investment banking firm who handles the whole initial public offering of the stock. There's the big stock exchanges. You've probably heard of some of those. Maybe you've heard of all of them. All right, so some more terms. So when we issue capital stock, in the old days, we used to have to declare some basic par value per share. In other words, some basic value per share of stock, regardless of what the market price of the share is. There are many states that still require this. And so you end up with this arbitrary number that's called the par value of the stock that means really nothing. But you still have to keep track of it on your books. So if you're in a state that requires a par value when you issue stock, you'll have, let's say you issue the stock for some value above the par value, you would have to record both the par value plus any capital in addition to par value. And you'll see in the examples coming up what I mean. But it's confusing for people. So now there's many states that don't require a par value, and so they call it no par value stock. So we'll talk more about it. Just know that when we talk about par value in stock, it really doesn't mean anything other than you have to keep track of it. And I'll show you how in a minute. All right. So if you remember from way back when we talked about the fundamental or the basic accounting equation that assets equal liabilities plus equity, we learned that equity came from really two sources. One is paid in capital, or money that's been paid in by the owners, right? If the owners contribute money to the business, then that's a form of equity. And the second is retained earnings, meaning any profit or money made by the business that it retains or holds into the business. So those are the two types. Paid in capital comes from common stock and preferred stock. And we'll talk about those in a difference as well. And you'll see right there it says paid in capital in excess of par, and like I said, I'll explain that more in a minute. Having clicker problems again. There we go. All right, so as an accountant, and we have to deal with these stocks, the primary things that are important to us is remembering that we need to identify where the paid in capital comes from, and we have to make sure that it's very clear in our books the difference between paid in capital and retained earnings. If we can keep track of that, then we're doing good. All right, so here's an example. Assume that Hydroslide Inc. issues 2,000 shares, $1 par value common stock. Prepare Hydroslide's entry if 1,000 shares are issued at $1 per share, and if 1,000 shares are issued at $5 per share. Here's where this issue of additional paid in capital that I was blundering through a moment ago will come up, and it'll make more sense when you see it as an example. So if they issue 1,000 shares for $1, then here's how they'll record it. Their cash will go up or be debited $1,000, and their common stock account will go up or be credited $1,000. That's it. If they issue them for $5 a share, they've got to record their cash now going up by $5,000, 1,000 shares, $5 a piece. Their common stock account still only goes up by $1,000 because the common stock account is always listed at the par value. So what do we do with the additional $4,000? We list it as paid in capital in excess of par value. So back to what I was trying to explain earlier, maybe it will make more sense now. There's this thing called par value that certain states still require, where you have to, when you create your corporate charter, put some basic par value per share of stock. It's an arbitrary number, but you have to put it on there. Then, forevermore in your accounting, you have to record any money paid in by owners at the par value and list that as common stock. And then any amount over and above that, you have to list as paid in capital in excess of par value. So that's what this example shows. Here's what the stockholders' equity section would look like. They have stockholders' equity paid in capital. Common stock is $2,000. Paid in capital in excess of par value, $4,000. And so you have a total paid in capital of $6,000. Okay. Now there's another issue, something called treasury stock. So treasury stock is stock that has been sold to the public, and now the company decides it wants to buy the stock back. Think of it in terms of sometimes we sell stock to raise money, but if the business is doing well, we'd like to have less ownership out there, so we buy back some of that stock. Sometimes we buy it back for other reasons too, like maybe we want to give our employees some shares of stock as part of their compensation package. Anyway, so there's a number of reasons we do that, and there they are. So treasury stock is a corporation's own stock reacquired from shareholders, but not retired. And retired means where we just get rid of it, so there's no more shares outstanding, or there are fewer shares outstanding. So generally, when we purchase treasury stock, we list it on our books as at the cost. When we do that, we debit an account called treasury stock. Treasury stock is a contra stockholder equity account. And our total stockholders' equity, our treasury stock will decrease by the same amount when we sell the shares later. So treasury stock will offset our total stockholders' equity, or decrease the amount of total stockholders' equity. So here's an example. February 1st, Mead acquires 4,000 shares of its own stock at $8 per share. So to prepare the entry, we simply debit a treasury stock account, 4,000 times 8, so $32,000. And we credit cash because we paid cash to buy those shares. Then our balance sheet will look like this. You see all the information that was there before, and then you say less treasury stock of $32,000, which leaves a total stockholders' equity of $668,000. So treasury stock reduces the amount of equity. Why? Because equity represents the amount paid in by the owners or retained in earnings. And so when we buy stock back from the market, that is stock that is no longer paid in, or amount that's no longer paid in by the owners because we purchased it back from them. And again, we list that at the cost. All right, so preferred stock. Preferred stock is a special kind of stock that most of us never really get a chance to buy. It's preferred in a couple of ways. First, it has priority on dividends, meaning if the company's paying dividends, remember dividends are a share of the profits, to the owners, the preferred dividend holders get their dividends first before the non-preferred or common stockholders. Meaning if there's a limited amount of money to pay out in dividends, sometimes the preferred holders will get dividends and the common stockholders won't. Okay. The second is they have preference toward the assets in the event of a liquidation. So if the company is sold or goes out of business, then we pay off all the creditors and then we sell the assets, the preferred stockholders are going to get their share first. The downside, they don't have voting rights, so they don't have the power to control things quite the way the common stockholders do. Again, often preferred stock will have a par value, so we'll have to record any sale of it first at the par value and then record any amount that we bring in addition to the par value. Here's an example. Stein Corporation, they issue 10,000 shares of $10 par value preferred stock for $12 cash per share. So they're going to record their cash showing up by $120,000. That's 10,000 shares times $12 per share. The preferred stock is going to go up by the par value, which is $10 per share times 10,000 shares. And the difference will be the paid-in capital in excess of par on the preferred stock of $20,000. Again, just to mention the dividend preference, not only do they have the rights to dividends before, but I failed to mention before that they often have a cumulative dividend, meaning that if the company didn't pay dividends one year and then pays it the next, the preferred holders have a right to what's called dividends in arrears, or dividends that weren't paid in the previous year. So now they can get last year's dividends and this year's dividends before the common stockholders can get any dividends. So that's a really nice bonus. Also, just know that the dividends on preferred stocks are usually stated in one of two ways, either as a percentage of the preferred stock's par value, or sometimes as a specified amount per share, as opposed to common stock, where dividends aren't preset, but instead they're set by the board of directors in any given period of time when they're going to be issuing dividends. All right, so here's an illustration of the cumulative dividend. Scientific Leasing has 5,000 shares, 7%, $100 par value, cumulative preferred stock. So 7% $100 par means that the dividends it will pay are 7% of the par value, or $7 per share. So each $100 share pays a $7 dividend. The annual dividend is $35,000. If dividends are 2 years in arrears, preferred stockholders are entitled to receive the following dividends in the current year. So they're going to receive 2 years worth of dividends in arrears, which will be $70,000, right? 5,000 times 7%, which is $35,000. I'm sorry, 5,000 shares times $7 per share, which is $35,000 per year for 2 years, makes $70,000, plus the current year's dividends. So the total preferred dividends would be $105,000. I mentioned that already. There's a liquidation preference, meaning that they'll get theirs before the common stockholders do, and it's usually based on the par value of the shares or some specific liquidation value. We won't see much of this, and most of you, when you own a business, you're not going to deal with this. This is only a handful of people that deal with these type of things regularly in their business practices. All right, so we've mentioned what dividends are before. This says a distribution to stockholders on a pro rata or proportional to ownership basis. That's just a nice way of saying it's a share of the profits, and you get yours based on the percentage of ownership you have in the company. There's 4 types of dividends: cash, property, stock, and scrip. I will tell you that the cash dividend is by far the most common type of dividend, followed by stock dividends, and then property and promissory type dividends happen a lot less often. Dividends are expressed usually either as a percentage of par or as a dollar amount per share, and I will tell you that now almost always it's a dollar amount per share. It's just more common. So a cash dividend, for a corporation to pay a cash dividend, it must have retained earnings, because dividends come out of retained earnings. It must have enough cash to pay the cash dividend, and the board of directors must declare that they're going to pay a dividend. These are the big dates involved in dividends. The declaration date, that's the date that the board declares they will pay a dividend. The record date, that's the date usually that says if you own the shares by this date, then you will receive the dividend. And the payment date, that's the date that they will actually pay the dividend. So here's an example. The directors of Media General declare a 50-cent per share cash dividend on 100,000 shares, $10 par value common stock. The dividend is payable January 20th to shareholders of record on December 22nd. So on December 1st, that's the declaration date, we create a journal entry that says cash dividends, $50,000, that's 50 cents per share times 100,000 shares, and dividends payable. On December 22nd, there'll be no journal entry. That's just the date that somebody has to own it by in order to receive the dividend. And on January 20th, they'll pay it, so there'll be a dividends payable going down and our cash going down. Stock dividends are a little different. Sometimes a company wants to issue a dividend but doesn't have a lot of cash, so instead what they'll do is they'll issue shares of stock to the owners. This allows the owners to get more stock based on the amount of dividends they would be getting. The results of issuing a stock dividend is that there'll be a decrease in the retained earnings and an increase in the paid-in capital. Remember, stockholders' equity is made up of those two things, right? Retained earnings and paid-in capital. So in essence, we're taking money out of the retained earnings and using it to buy up more stock, and that's going to go to the owners. There's the reasons why corporations issue stock dividends. I already mentioned some of those. The effect, like I said, it changes the composition of the stockholders' equity. The total stockholders' equity remains the same, but the retained earnings goes down and the paid-in capital goes up. So here's the Medlin Corporation. They declare a 10% stock dividend on $10 common par common stock, 50,000 shares outstanding. The market price was $15 per share. All right. So what's going to happen if it's a 10% stock dividend? That means that they are going to, sorry, I'm thinking my way through this with you. So if the common stock was $500,000, now they're going to do 10%, so they're going to have an additional $50,000 worth of common stock purchased. That's the 10% stock dividend. It's based on $15 per share. So we're going to have a total paid-in capital increase of $75,000. Retained earnings will go down by $75,000. So the change to total stockholders' equity will be 0, but the change to shares outstanding will be 5,000. I'll tell you why I got confused. My brain skipped for a minute. So typically, when we say a 10% stock dividend, it means we're going to say we're going to add 10% of the shares outstanding. So they take 50,000 shares, multiply that by 10%. So they're going to issue 5,000 more shares. Those 5,000 more shares are selling at a market price of $15 per share. So they're going to show the $10 par, so $50,000 added to common stock, plus another $5 per share in additional paid-in capital. That's the $25,000. Hopefully that explains what all that change means. Sorry if I was stuttering through it for a moment there. And then here's after the dividend. So now the common stock account will be $550. Paid-in capital will be $25 for a total paid-in capital of $575. And the retained earnings will be $225. Total stockholders' equity will still be $800,000, but now there'll be 5,500 outstanding shares. That's what a stock dividend looks like and how it works. A stock split does something a little different. Sometimes the company wants to reduce the market value of the shares. This is often because people don't want to invest in a company if the stock price gets too high. So what they'll do is they'll do a stock split. And a stock split, in essence, if you do a 2-for-1 stock split, that means that for every share of stock someone owns, they'll now get 2 shares. So they'll have 2 shares instead of 1. What happens though is the par value decreases and the market value decreases. So if I had 100 shares that were worth $10 a piece, I'd have a total value of $1,000. If they did a 2-for-1 stock split, I would now have 200 shares worth $5 a piece. My total value would still be $1,000, but I'd have twice as many shares. This would be great for dividends. It would also be great if the stock price begins to climb again. And again, the reason companies do it is to keep the market price of their shares relatively low, so investors will be induced to keep buying. So here's an example of a stock split. 10% stock dividend. Instead of issuing its 10% stock dividend, Medlin splits its 50,000 shares of common stock on a 2-for-1 basis. So before the stock split, their common stock's worth $500,000. That's the total of the paid-in capital. The retained earnings is worth $300,000. And their total stockholders' equity is $800,000. There's 50,000 shares outstanding. There'll be no change to any of the values except for the number of outstanding shares. So they're going to add 50,000 outstanding shares. Remember when they do that the stockholders get to maintain their percentage of ownership. So when they double the number of shares, then the stockholders that are already out there are going to double the number of shares. So now you'll still have 500,000 in common stock and a total paid-in capital of 500,000, retained earnings of 300,000, so a total stockholders' equity of 800, but 100,000 outstanding shares instead. Here's the difference in the effects of the stock dividend and the stock split. So the total paid-in capital with a stock dividend increases, but with a stock split, there's no change. Total retained earnings on a stock dividend will decrease. Remember, with a stock dividend, we're just taking money out of retained earnings and buying up shares of stock. But there'll be no change on the stock split. The total par value of the common stock will increase on a stock dividend. and it will decrease on a stock split. The par value per share will have no change. Shares outstanding will have an increase. So hopefully that clarifies some things. Of course, you may have to read through the book as well. Remember we learned about retained earnings. That's the net income that the company retains for its use. When we make a profit or a net income, that will increase our retained earnings. When we have a loss, that will decrease it. Retained earnings is part of the stockholders' claim on the total assets of the corporation. In other words, this is part of the corporation's assets that the stockholders own. And occasionally a company can have a debit balance in the retained earnings account, and that's also known as a deficit. That means that the company hasn't made a profit, and so it's made a loss, and so it has not a retained earning, but it has a deficit. There's an example of one right there, company, Amazon.com. They have an accumulated deficit of, and this is in millions, so add 6 zeros. That's a lot of money, right? That would be $1,375,000,000 in accumulated deficit. Sometimes a company has what's called a retained earnings restriction. What that means is even though they have a certain amount of retained earnings on their balance sheet, they can't use all of them because they're tied up in other things, contractually, legally, or sometimes voluntarily. So what they'll do is they'll put a note in their financial statement just saying of their retained earnings, a certain amount of it is restricted and a certain amount is unrestricted. And again, on your balance sheet, just remember the paid-in capital is going to be split into the capital stock and any additional paid-in capital. Remember, capital stock is always listed at the par value, and additional paid-in capital is listed as any amount over and above that par value. So there's a larger balance sheet. This is the stockholders' equity section. You can see the paid-in capital. This company has capital stock of $600,000, and common stock. Oh, I'm sorry. Preferred stock of $600,000, common stock of $200,000. Remember, that's at the par value. And then it has additional paid-in capital, and you'll notice they split that out for the preferred and the common stock. And then they leave you a total additional paid-in capital. So the total of the stock and the paid-in capital is the total paid-in capital. Then there's the retained earnings. Then you have the total of the paid-in capital plus retained earnings, less any treasury stock, and that's going to be their total stockholders' equity. A couple little ratios you'll want to know. The first is what's called the payout ratio. Sometimes it's called the dividend payout ratio. That's the cash dividends declared on common stock divided by the net income. And earnings performance, which we call return on common stockholders' equity, or return on equity, which is the net income, subtract out any preferred dividends, and divide it by the average common stockholders' equity. And remember, to find the average, we would take the common stockholders' equity at the beginning of the period, add it to the common stockholders' equity at the end of the period, divide by 2. Here's an example. Medline Corporation declares they just want to give you one more example of a stock dividend entry in the appendix here. So Medline Corporation declares a 10% stock dividend on its 50,000 shares, $10 par value common stock. So this is just like the one we just talked about, but I guess they want to show us how to do the entry. Current fair market value of its stock is $15 per share. Record the entry on the declaration. So you're going to have a stock dividend of $75,000. That's 50,000 shares times 10%, which is 5,000 shares, times the market value of the stock, 15 bucks. So that's the amount of dividend they're going to enter. The common stock dividends distributable will be $50,000, and the paid-in capital in excess of par will be $25,000. Then when they issue the dividend, the common stock dividend distributable will go $50,000. Common stock will increase by $50,000. And that's it. All right. So this chapter, in my opinion, has some some concepts that are foreign to many people because they don't deal with them, but that they're a little easier to get your brain wrapped around than the bond stuff from Chapter 10. So hopefully you'll be able to get through it without too much trouble. If you do have too much trouble, let me know, and I will do my best to help.